Okay, well, yeah, brilliant. Welcome everybody. Thank you so much for joining us today. Today's session then is around what the UK budget means for SMEs. It's slightly a week later than a lot of the headlines. And sorry, Paula, would you mind just muting yourself? If that's okay. I think we're getting a bit of background. Thank you. That's great. Yeah, a week after the budget's dropped, we thought it would allow everyone a bit of time to kind of digest it and give you the opportunity to kind of reflect on it from your own personal perspectives and give you access to our team of experts who know this in a lot of detail, have also had a lot of time to digest it as well. So today's session, then we've got an hour together, and during this session, we will do roughly sort of 30 to 45 minutes of different topics that we've already sort of planned, and some of the stuff we shared actually in the sort of event reminders leading up to it. And our intention today is very much to be a super sort of pragmatic session, and really to kind of give you some of the macro trends from an SME perspective, but also kind of from a business owner perspective, kind of what that means too. And just as a bit of background, so I'm Jane Gerard, and I'm the co-founder of the SME Innovation Network. And our community is was created really to kind of provide support to SME businesses to kind of help them scale and grow. And we have a team of experts that specialists in a cross section of areas around supporting SMEs and their businesses. And as part of our community, we effectively are trying to democratize a lot of the consulting support the corporates get and make it much more accessible to the SME market. So that's kind of a bit of background on us. So we're not the usual networking group; it's more of a support group. Today's topic is not really what we would normally sort of cover, but because it's been so much sort of interest, discussion, sort of nervousness, and all that in build up to it, we thought it was really important that we at least had a session on it. So that's kind of how this session came about. And today on the call and on our panel, we have Nicholas Polkinghorn, who is from Ironbark Wealth Management. And Nick is the managing director and a chartered financial planner as well. So Nick will be providing some insights from that perspective. We've also got Jessica Britton from Edwin Co. And Jess is a estate and tax planning solicitor. And we've also got Manish Tanki, who is a chartered accountant from Meridian Accountancy too. So quite a cross section of expertise, which will allow us to kind of tackle it from a number of different angles. And we hope today will be a good and insightful session for you. So as we go through though, please feel free to just drop questions in the chat and I'll kind of keep monitoring it and I'll sort of feed it to our experts as we go, subject to how it flows. I'll either weave that in throughout the session or we might just save it towards the end. So we'll look forward to a good conversation. So let's get started then. So we're going to start kind of at a macro level, and Nick's going to kind of kick us off. So the first question then for you, Nick, is given the current macroeconomic climate with interest rates, inflation trends, and the government's fiscal stance, what do you think SME businesses or owners should be paying close attention to over the next 12 months?
Thanks, Jane. Nice small one to kick us off there. I think from a macro perspective, at least, the budget at least sort of made the right noises on SME growth. If that's proof will be in the pudding as anything, and I'll probably say it about 10 times today. But I was frankly surprised that things like enterprise investment schemes, venture capital trusts were, they actually came up within minutes of the Chancellor getting up on the dispatch box. And that was kind of extraordinary, I thought. Anyway, from my perspective, we use those particular tools to get our private clients access to the kind of work that SMEs do, which is hopefully everyone on this call knows is something that that the UK does very well. Um, I think whilst getting some tax relief along the way, you know, VCT relief is dropping down to 20%. But I think that's a bit of an anomaly. It matched EIS relief at 30% prior to that, even though EIS in my mind, and I think generally, they're meant to be smaller companies in there. So therefore, that was a nice to have, but it probably should have been trimmed, and we would have been expecting that for a while. Just not from this government, if I'm going to be honest, because I didn't think they'd be looking in this particular area that much. The Yeah, funny enough. I got an email this morning. I've just brought it up, so I'll just read this out. This is from British Smaller Companies VCT, and I think it's generally the theme on funding for SMEs that has come off the back of a budget, and this is from the again from the private client point of view. So BSC has said, there's been renewed focus on the VCT industry. We welcome the proposed increased investment limits, which will enable, BSC VCTs, but all VCTs to back their winners with more capital for longer. And I think that's a really, I think that's a really good point. Again, the devil's in the detail, but if they're allowing, these sort of conduits of capital into the SME environment, that's going to be really helpful. And I think at a top-down level, it shows that extraordinarily, this government has made greater recognition of the importance of SME space to the UK economy, and so hopefully that bodes pretty well. Um, I think there were some surprisingly good intentions in the budget, whereas beforehand I would have imagined they'd be slightly more punitive. We saw last year with the NI was a great example that they kind of, when they first got in the door, at least, they kind of had this idea of business as almost as the enemy. They didn't have the idea of a business being a living, breathing thing run by people and, it all being realistically people based. So hopefully a lesson's been learned, I think. Um, but again, I think the main thing there is the right noises were made, and with surprisingly higher level of technical insight than I would have potentially expected from them. So hopefully, good things. Watch this space. Regarding inflation, it's a bit of a tricky one. Whenever inflation's high, governments are quick to say it's completely out of their control, and whenever rates come down, they're very quick to claim all the credit for it. I
Mhm.
think, this government keeps saying they'll get inflation under control, but they've got limited levers to pull from where I sit at any point. The bottom line is any giveaway budget is going to be inflationary. And so at its most basic, I would, say that inflation will continue to an extent. Caveats both sides being unless the you know, tax rise on those who actually spend in society lop it off at its knees, um, or conversely that markets do indeed decide that this budget is relatively unsustainable, a la Liz Truss, but I don't think that's necessarily um, going to be an issue. I think the difference is we've kind of got a government at the moment which is slightly unsure about this area and unsure about where they stand, whereas previously what we really had was, the hubris of the trust budget was something else, just ignore the OBR, etc. Um, so it's a bit of an unknown there with inflation, but I think most importantly for anyone or any company trying to plan, it's that inflation stays steady and we don't see the swings we've seen in the past few years. I think again from my perspective, and hopefully everyone agrees on this call because it's relevant. Inflation itself isn't the killer; it's the uncertainty. Um, and I think a nice little fact that we talk about often at work is that there's a really interesting point about this 2% target that we see absolutely everywhere. It comes up in the press, in the newspapers, whatever you like. And the BOE is, in my view anyway, slightly stuck here. So much focus is always put on this target that for the Bank of England to ever think about moving it would cause all sorts of people to, I think, frankly, lose their minds, and various accusations would fly around, and it would be a real talking point, and people would get hepped up on both sides of that. And taking a step back from that, again, it's really important to remember that that target was put in place off the back of the GFC. And the whole point about the B of E target of 2% was that was aspirational. So inflation was so low at that point and even negative that we were trying to push to 2% to get inflation up there. But the target stuck. And now that we've gone up and ahead of that, people now sort of say, oh, but it needs to be 2%. But it's relatively arbitrary. Trying to get up to 2%, not now we're trying to think people coming down to 2%. I think if we reframe it in that way and remember that, it just gives us a bit more emphasis on the need for a steady, again, inflation rate, not necessarily a low one. And that sort of moves us on to interest rates, where hopefully we'll see some further minor cuts to give everyone a bit of breathing room. Again, though, has to be done in the knowledge that rates at the moment are still low compared to sort of all-time averages. They just seem high after the ultra low rates we've seen for the last 18 years or so. So I guess that's a very long way of saying that we should be, looking out, that we should be looking out for SME owners. What we should be looking out for rather is stability over the coming months and years, and that is how does this budget succeed or fail in offering confidence to the UK, and hence how businesses are actually able to get planning. That makes sense.
Yeah, that's great, Nick. Nice and yeah, thorough. That's good.
Sorry, I
Um,
do awful.
Next question then. How and some of this you've kind of covered already a little bit, but how do you see this budget, this budget impacting sort of the personal financial planning measures business owners need to take specifically?
Yeah, I mean, that's really important, and it's very much what we do at Ironbark is sort of straddle that idea between the business and what's personal, and look at the personal advantages that people can take. Um, I think the budget in my view, suggests we need to sort of ensure that we're, using what advantages that we can. The government's clearly indicating, in my view, that reliefs and exemptions are basically dirty words, and they're going to sort of nitpick at whatever they can and be limiting and reducing those. So I think rather than the day-to-day running and structuring, what we focus on is how to use your company efficiently for your own personal situation where possible, and how to get any money that's not being spent or reinvested to reach your hands in the most tax efficient manner possible. Um, we'll all be aware on this call again, we've seen a change to entrepreneurs relief, or business asset disposal relief, as they cynically changed the name a few years ago. That's now 18% on the first million from April. Again, I wouldn't like to tread on Minish or Jess's toes of what they're going to talk about, but I think there's certainly an element there that if you were considering selling your business or part of, or passing some of it down to your children, there might be a limited window in which to prevent an 8% tax. Again, that's maybe more on the other guys. Also from April, there's a 2% rise on the dividend tax for basic and higher rate bands, and that's important for remuneration strategy. And again, should be discussed with one's accountant as well. So what I generally see and we see is that these strategies very much differ from person to person, company and company, depending on what priorities are. So again, probably one for you, Manish. But what we'd be thinking about is remaining as tax efficient as possible, um, whilst also considering making sure we're not bringing any tax forward unnecessarily. Uh, Conversely, would leaving cash in the business sort of introduce any business risk or tax implications into the future, and weighing up, what your present day needs are compared to what your future needs are. Um, which I guess also takes me on to pension contributions, hugely important. And I think one main thing for SME owners to note is that at this point, the national insurance rate we've seen, that all the talk about salary sacrifice, that shouldn't affect SME owners. I think that's a real positive and a really good thing to take away. There remains no more tax efficient way of getting cash money out of your business into your own hands, into your own name, rather than ahead of taking pension contributions. We call it straight through money. It's a deduction for corp tax, it's a deduction for income tax in your own hands, and tax won't be paid on that money at all until you decide to draw on your pension. It's effectively like the money was never in your company to begin with. So that's sort of a really good takeaway on that front as well.
Thank you, Nick. And actually, just on that pension bit, is there anything more around sort of pension allowances, tax relief you want to add to that, or does that kind of cover it all?
I think that covers most of it. So, the real difference is for this salary sacrifice rule to come in play, there has to be a contractual sacrificing of the salary, funnily enough,
Yeah.
into a pension. And they're going to, they've said no to that. They're going to be adding NIs. With most SME owners, there's simply discussion with their accountant around how much cash in the business might be allocated to pensions on a yearly basis. And
Mm.
this often moves around. So, pension contributions from a business will still be exempt from the NI changes. Um, and there's still full relief on the business. So I think that's still a bit of a win. And it's worthwhile noting that for anyone who has a pension or has a previous legacy one, it might be from, I don't know, working at McDonald's when you're 18 or something, I don't know. But even if if as long as someone had a pension in the past, if they haven't contributed for the last 4 years, you can use your carry forward relief. And so what we have right now is a situation where business owners, or well, anyone, but specifically business owners as well, in this call will have up to sort of £220,000 worth of potential allowances they could be moving into a pension from their business.
Yeah, it's great. A few levers to pull.
Yeah.
We like that. Going on to the topic then of electric vehicle incentives. So they've shifted a few times over recent years. What does, based on the announcements, do electric vehicles still offer a tax efficient way for businesses and business owners to kind of benefit from?
I mean, the math says a bit of a movable feast. I think the 3p a mile will affect some people, but if we consider that in relation to fuel duty, which sits at 5 or 6p a mile, that's okay.
Mm,
Uh, the day-to-day costs really depend on, whether you can charge cheaply at home, and so it's really sort of personal to everyone. But from a business perspective, an SME owner has a number of ways to buy a car. If they buy it outright, it's a full deduction for corp tax. If you lease it, it's an expense for the business as well.
mm,
And again, I think, even sort of, your road tax, your servicing, repairs, those are all expenses that can be borne by the company and can be deductions there as well. Again, in a similar way, that's sort of straight through money. Um, not quite sure yet about parking tickets, but maybe Manish can let us know about those. Those ones might still have to be borne, but they're still very, very tax efficient from a company perspective to provide those to yourself.
Yeah, that's good to hear. And I think Manish, you enlightened us on grey, or yeah, I think it was grey, wasn't it? Grey Teslas as opposed to white Teslas. And I'll let you can talk a bit more about that in a minute. Okay, so final question for you then for now, Nick. So protection is often neglected, and you can probably give a bit more of a description on what that means, protection as such. But what does that protection mean in terms of sort of income protection, shareholder protection, and key person planning?
So protection just sort of is a broad term referring to, effectively any kind of insurances put in place to either protect you personally, your family, or your business.
Yeah.
So the ones you mentioned, we have relevant life, shareholder protection, and key person insurances. So those are all costs that can be borne by a business. Relevant life is really good because it kind of straddles the personal to the business. You basically have a business paying, or you have your company paying for your own, effectively personal life insurance. Um, and again, Jess might have something to say on this, but that's a bit more relevant now that we're also looking at IHT on businesses over 1 million.
Mm,
So where there's a known IHT liability coming up, there's a really good argument to say that grab a relevant life policy, have the business pay for it. Again, it's a tax deduction for the business and pop that in trust.
mm,
Um, Shareholder protection, that's and key man insurance. Those are sort of a couple of bolt-ons really. So key man insurance is basically looking at the cost to a business should something happen to someone, should they no longer be able to do their job, and it
mm,
can cover things like loss of revenue up to hiring the replacement for that person. And in a similar way, shareholder protection again can be a business expense, and that means that you can put in place a policy which just say, you know if one were to pop their clogs, and effectively what that does, it pays out to the other shareholders to then buy that element of the business from the estate, from the family of the owner who's passed away. So that just means that the partners have maintained full control on the business, and you don't suddenly have family members who may have
mm.
sort of no real clue what that SME is doing in terms of day to day, and it equally might not be interested in doing so. So those are some nice sort of basic ones, which again, the idea there, I guess, in terms of this particular budget is it's not so relevant or mentioned, but if they can keep the tax costs down by basically getting money out of the business to serve a real purpose, then that's always a useful thing. The other ones you mentioned in terms of, for and I think it's valid for SMEs in terms of keeping staff as well, but things like private medical, income protection, critical illness, those are P11D benefits, so they are taxable in the hands of who has them. But again, still something that could be done within the business itself and a useful thing there too.
Yeah, that's some really good measures, I think. Yeah, give a lot of peace of mind to a lot of families, I'm sure, as well. Great. Okay. Well, wonderful. Thank you, Nick. And we'll come back as we continue. But for now, moving on to the wonderful topic of sort of salaries, dividends, and tax efficient remuneration. Can't even say it right. So Manish, there's always a debate then around sort of salary versus dividends. How do you sort of maximize that to kind of get the most benefits? How do you see that this budget has influenced that sort of tax efficient structure for businesses?
First of all, good afternoon, and thank you to everyone joining this call. If there's any jargon or anything, just stop me, put something in the chat. Today, I'm just going to share my Barbar sheep conspiracy theory with you all. And what I'm going to do is I'm going to talk about three things, which is a tax track, tax structure, and the elephant in the room, moving to Dubai. So if you think about the business as a patient, what we're feeding it, that's the health of the business. And unfortunately, taxes, you're taking blood out of the business. So you need to make sure you minimize the amount of blood you're taking out, because that money you can spend towards a sales budget, growing the business. And always remember, an SME is likely to fail within the first 3 years. And people don't admit it, but it's normally your tax bill. If you had that extra 10, 15,000 pounds that you paid in tax, where would your business be now? You'd probably still be in business. So salary and dividends are very important. So first of all, in the first 3 years, you probably won't claim salary. So you'll still be depending on family members, or you'll be, struggling on using up your savings. That's something that you don't really want to do. And I see a lot of people think that, oh, having a limited company is only for rich people, having a VAT in Northern Ireland is only for big VAT people, or having a business in Netherlands or Dubai, oh, I need to be earning a lot of money. No, it's not true. And I think the government's giving sort of signposting as everyone to look at our tax structure, become a limited company, because if you've got a buy-to-let property, even if you've got one, you can still keep it in your own personal name, but the rent you can put into your limited company. So you pay a corporation tax of 19%, and you can still claim your mortgage interest and your mortgage payments. Now, as a sole trader, you can't do it. So I've got clients that have only got income of about, say, £10,000. In reality, they're paying about 8,000 or 4,000 pounds in mortgages and expenses, but they're expected to pay tax on the full 10,000. And when you speak to them, they don't want to change for some strange reason, because they've still got this sort of mindset. It's only for rich people. But now, in terms of businesses, there's sort of a two-tier system. There's a first class and a second class citizen, even as a business owner. And if you learn from the Americans, they sort of start delegating stuff. And that's the first thing you should do, start delegating your tax. You even thinking about investment, thinking about how you pay yourself as a salary. And the only thing is the tax will get higher. And with the bans, I've got people that are GPs. They said, I don't want to work anymore now. And that's not an option for a business person. You can't say no to orders. So what do you do? And I think you need to sort of concentrate on the tax structure and have a look at the way over. You've got a lot of people that work remotely, and there's nothing wrong with that. There's no prohibition that you can't have your business in Netherlands or Ireland or wherever to actually reduce your tax. So it's about working smart and not relying too much on Google and ChatGPT.
And Manish, is there any new areas then, or new benefits that come out of this budget? Any blind spots that people need to sort of be aware of, or they can leverage?
Well, they're still there. We've still got you can still buy your Teslas to reduce your corporation tax, which is great for the Tesla Car Association Club. And the pensions are sort of reduced, but the idea is look towards the stock market. Now, the ISA, they've reduced the cash one from 20 to 12. The reason is that you've got so much capital in the banks at the moment, and the banks are not really reinvesting it. So if you look at TSB, they're not allowed to invest your savings in the stock market. And what they want to do is they want to copy America. So if you put £8,000 in stocks and shares, not necessarily the FTSE, you can put it in the American one, the Dow Jones. But what they want you to do is use up that £8,000 to build up your pension. So if you think about it, if you've still got 20 years left, you're looking at a pot of about 160. So even if it generates about 5%, that's £8,000 that you can claim tax free. And even if you sell those shares, there's no stamp duty. Because another thing is they're trying to reduce capital gains so much. So if you have a share portfolio or a property portfolio, you're sort of silly to keep it as a sole trader. Even if you've got a buy-to-let property portfolio, it's just your husband, wife, and your children as directors, you can set up something which is called a family investment limited company, and the shares that you can transfer are actually free of stamp duty. Inheritance tax still applies, but that's another way around gifting. So you have a lot of people that have got elderly parents who are property rich, cash poor, and they don't know what to do with the property. And that's just another option. But it's about working smart. And these solutions aren't expensive. You don't need to go to the high street. You don't need to have an accountant or lawyer from London. This is something that you can actually get locally, but you need to ask the right questions. I think with you might go to your GP. I've got something. I've got a shoulder pain, but they won't look at the whole body. So you just need to find a trusted advisor that looks at the whole body, your whole tax portfolio. Ask the questions. First of all, why are you doing business? Is it to generate extra income? Is it to generate an extra holiday? Are you trying to do something that the government doesn't want to do? Become wealthy and independent? And unfortunately, it's always like a sort of Darwinian. It's the survival of the fittest. And that's my conspiracy theory.
I like it. Yeah, that's good. So yeah, quite a lot of different things there, Manish. I mean, is there anything that you think they should just focus on as a priority within that to kind of
look at tax structure, and if you do grow big, have a look at Dubai. But also plus and minus, they don't charge tax, but they charge fees. But you have to see, well, if you're registered in Dubai, you don't have to pay the capital gains. But would it be better to have a limited company where you just pay the corporation tax, so you completely eliminate capital gains? So you didn't really need to go to Dubai. You just needed to change it over, open a limited company yourself. So you could have gone for a cheaper solution.
Yeah, I guess it goes back to, as you sort of pointed out, the overarching goals that you're trying to achieve and work it back from there.
It's always ask your accountant the right questions, ask the lawyer the right questions, ask the financial advisor. Before, the bank manager used to help you, but that system's not there. And most business mentors and business advisors or business coaches, unfortunately, they don't know that much. It's all about, they're more on social, or more about marketing. Spend this much on Google, spend this much on, make X amount of sales, it'll cover your tax bill. But you could have your cake and the cherry. Get your sales, but make sure your structure's in place at the moment. So.
Yeah, smart stuff. So you need that team around you.
You need that team, and you have to have people there. They're in business as well.
Yeah, that's true. It definitely helps.
They're not the comfortable fat cat business coach. That's another conspiracy. If anyone's a business coach,
we'll do another session on that, Manish, I think.
I'm not against business coaches, but I'm just saying.
We know a lot of good ones.
They preach, well, but they don't do the walking. So you need somebody that does the talk and the walk at the same time.
So I think that gives me a good segue to talking about the next hot topic, which is inheritance tax, which is always a fun one. And Jess, start you off with a great question. With regards to this budget, then, what immediate implications have there been around inheritance tax planning?
Well, I suppose first thing to say is that actually from an inheritance tax perspective, not a lot happened in this budget. And certainly not a lot given how much speculation there was in the lead up to it. And the rumour mill really was going quite crazy. So I suppose just to start off with some of the rumours that we heard, which didn't happen, there was lots of discussion in advance of changes to the gifting regime. So what we call PETs, so potentially exempt transfers, when you're making a gift and trying to survive it by those 7 years. Lots of talk about the 7-year rule increasing, or even there being sort of a lifetime limit on gifting, and that once you reached your lifetime limit on gifting, that taxes would be due. Again, that's not happened, so that's a small win. There was discussions of a wealth tax, and that being another tax separate from inheritance tax, which is already charged. That's not happened. Another one was discussion of an exit tax. So when you do exit and plan to leave the UK, were they going to levy an exit tax on you then? They haven't announced that in this budget, so that's a good thing. And although, as Nick mentioned, changes to entrepreneurs relief, we didn't actually see a change in sort of the rates of CGT, which I think lots of people were nervous of, and lots of the estate planning we do involves properties. So yeah, not seeing changes in those rates there was probably quite a positive thing. The few changes we did see from an inheritance tax perspective, relatively minor, I suppose. The nil rate band that we talk about, everyone's 325, that being sort of the tax-free allowance each person has to pass on assets when they die. That's been further frozen, so they've frozen it until 2031. And that is the same figure that they set back in 2009. So it really, that's a huge amount of time where we've kept our threshold exactly the same. Interestingly, I think lots of people talk about fiscal drag in relation to income tax allowances, but the exact same thing is happening with inheritance tax, because estates that didn't previously pay inheritance tax, because the threshold has stayed the same, but property values have increased. They are more each year, more and more people are falling into the scope of inheritance tax, really. Another announcement from this budget, which sort of follows up on the last year's one, really, that the 1 million allowance for business property relief and agricultural property relief that was announced last budget. They initially announced it like it was an individual allowance for each person, and that it might not be transferable between spouses, and that it was sort of a use it or lose it type situation, which didn't really seem sensible, didn't really follow the nil rate band type structure that we have. So pleasingly, they've announced that now would be transferable. So if the first spouse or civil partner passes away and doesn't end up using that allowance, the second spouse civil partner would have sort of a 2 million allowance to set against any of their business assets. And there were some tweaks again on sort of talking about the pensions coming into IHT. There were some updates on sort of the processes and the liabilities, how that's going to work. But yeah, it is still coming in from April 27. So those are sort of the approaching deadlines for us, are changes to the business relief rules next April, and pensions from the April after that, I suppose, are the key things from an inheritance tax perspective, really.
And I think, Jess, you've touched on a few bits there, but the many SME business owners assume that their business assets are automatically going to qualify for relief. I think you've covered a few points in what you just said, but is there how true is that, and is there any additional things that people should be doing right now?
Yeah. So yeah, there's quite a well-known relief for inheritance tax purposes, or business property relief or business relief. And often it's mentioned at the same time as agricultural relief or agricultural property, but obviously they are separate. Probably do qualify, but there are strict rules set out in the statute, and if you slip up on any one of those rules, obviously potentially quite significant inheritance tax consequences. So I suppose the key criteria to apply are the company itself, or the business. It has to be it has to be running a trade, so it needs to be a trading company. And HMRC define that as a business that is not wholly or mainly for the purpose of making or holding investments. So if it is a company, if it is a business that is holding properties and sort of generating a rental income, that is not considered a trading company. It needs to be providing services, producing something more of a trade. So that's sort of one of the first main criterias. Another criteria is that the business assets or the shares, whatever it is, need to have been held by the individual for at least 2 years before a death or before a transfer. Sometimes I suppose people can come unstuck there if they've been a shareholder for a long time, but they received sort of more shares on a certain event, or more shares were passed to them by a family member. You've got to make sure that whatever shares or assets you're dealing with, you're definitely ticking that 2-year criteria for the relief to apply. And then another final one, which can often catch business owners out, is accepted assets. So people might have heard of that before. That is even if the business as a whole is trading, if you meet the 2-year requirement, if you have accepted assets in your business, that can hinder the relief. And an accepted asset is something that is held for more of a personal use, we say, for the business owner rather than for the benefit of the business itself. That could be something like a holiday home that is held within the company structure that the business owner uses, and it's not really used actually for the trade of the business. Or a more common one is just excess cash. If the business is sitting on a lot of cash, more than HMRC sort of would deem necessary for that type of trade, they would treat that as an accepted asset for the business relief rules. I suppose really important for SME owners at the moment to probably check that they do qualify for these rules. And the best people to do that are probably their accountants. If they're working with accountants now, accountants are preparing their annual accounts. They can be quite well placed to know what assets are in the business, how the business is operating, is it running a trade, and just get that certainty, that confirmation from the accountant now would be quite a good thing for SME owners. If they don't sort of have someone that's quite integral, an accountant that's quite integral to the business, they can instruct sort of tax advisors to come in and look at the business. Is it satisfying all the rules? But yeah, really, really important to do that before sort of any estate planning is undertaken. So yeah, getting that certainty is definitely a good idea. And alongside that, at the moment, we're talking to lots of business owners about maybe valuing the business and making sure they sort of understand what the value likely is if there was to be a sudden death, or if they do want to undertake any estate planning. So again, company accountants can be really helpful there. What is the value of the business? Are we looking at sort of around that 1 million allowance? Are we well above that? Are we comfortably below it? Because I suppose we're expecting to see that if you're very near a threshold, HMRC are going to investigate that quite thoroughly and check, actually, are we suppressing any values here to fall within an allowance? Is that sort of the true value of the business? And previously HMRC didn't have to do that. They would just, if you tick the criteria for business property relief, they didn't have to worry about what value you put down, because it was just 100% relievable. But now that we're putting these sort of thresholds in, they've got sort of, there's a bit more incentive for them to look into actually what values are being put on these trading businesses. And yeah, I suppose once they've got an idea of the value, if they are above these thresholds, trying to plan ahead and think what would be the inheritance tax liability if someone passed away. Do we need to speak to someone like Nick and get some insurance in place? Yeah, all those sorts of things, really important for planning if you're wanting to sort of pass the business on to the next generation. How's that business going to be able to survive with that tax bill falling due potentially on someone's death? Yeah.
Yeah, lots of amazing stuff there, Jess. So just to conclude then, what do you see as the biggest missed opportunity businesses or sort of SMEs delay when it comes to their estate planning, sort of gifting, succession planning, trusts, etc.
Yeah, trust is a very interesting topic that you raise. Under the current BPR rules at the moment, you can, where there's unlimited relief on sort of an unlimited value of a business, you can do some very inheritance tax efficient planning by passing business assets or shares to a trust during your lifetime. You have to be excluded from benefiting from that trust. So it is a trust for your family, it's for your children, your grandchildren. It's sort of, if you don't need to benefit from that asset anymore, can you give it away? You could give it to a trust. And current rules, there'd be no upfront inheritance tax charge on that. But obviously from after April next year, with that 1 million threshold coming in, if you are wanting to do any estate planning with your business, transferring assets to trust, there's going to be that cap sort of on what you can do tax free. So yeah, potentially an upfront tax charge on the way into a trust. So that, yeah, we're speaking at the moment to lots of business owners about, can they undertake any estate planning with their business assets before April 26? And sort of, yeah, fleshing out, does that work for them? Does that work for their family? Don't do it just for sort of the inheritance tax planning if it doesn't work actually for the family. But trusts can be quite a good way of passing on wealth because you can't benefit from it anymore, but you can retain control of those assets. So you can be a trustee of the trust, which is holding some shares in your family business. You carry on making the shareholder decisions as if you were still the owner of those assets, but it's just when dividends are paid out on those shares, or if those shares grow in value anymore, that is now outside of your estate for inheritance tax purposes and in this family trust. So yeah, that can be a good way of mitigating inheritance tax, but also sort of retaining some control over the assets. Having said that, tax planning, you can't just look at one tax when you're coming up with these ideas. So you can't just be focused on inheritance tax. You need to think about what are the other potential tax implications that are relevant to transfers of business assets. And those have been mentioned. So make sure CGT, is that going to work? Stamp duty. Speak to your financial advisor. Can you afford to do this type of planning? And also get some corporate advice and make sure the company's articles allow for it and all those sorts of things. So it's a potentially really sensible tax mitigation piece, but there's sort of quite a few parts that need to be considered before you do it. And obviously time's ticking if you want to do it before April, before the 1 million thresholds come in. So yeah, that's a really interesting, quite busy piece of work at the moment that we're talking to lots of business owners about. But as always, I wouldn't be a good private client solicitor if I didn't say that business owners all should have, really should have wills and powers of attorney as well. So that's something we've always done for business owners, and obviously that's not changing. But I just have to put a plug in there for making sure business owners have wills in place. Any will is better than no will, probably. So yeah, really important.
I couldn't agree more. Yeah, it's one of those boring but completely necessary things.
Yes, exactly. Yeah, that's what we're here for.
So I think from what we've heard, I mean, there's lots of, it wasn't as dramatic as probably we were expecting budget-wise, but there is still a lot of levers that you can pull as business owners. But we thought we'd go to the fun topic of why we're seeing a lot of Brits move to Dubai. I've certainly seen a lot of it in my own world, me being one of them at one point as well. So we thought that'd be a good one to kind of address as part of this. Nick, I think we'll start with you on this one. So why do you think we're seeing such a huge trend? And in your view, what are the top drivers?
It's a funny one, to be honest. So, yes, it's, we read a lot about it. Personally, I haven't seen an awful lot of it. From the conversations I'm having with private people who are, very heavily taxed, and they're kind of slightly sick of being told they've got broad shoulders. But the reality of the piece, when you sit down with somebody, say, right, well, let's plan this out. Let's get you in a good position to go. And it's funny. It always seems to be Dubai. I mean, it could be, there are loads of other places that people can go. We know that various European countries have really good sort of tax moratoriums effectively, and as does Asia and whatnot. It doesn't always have to be off to the desert with thee. But I think what I find anyway in my work is that once you have that conversation, like, right, well, talk to me about where you're going to live and schools and your family and your friends and your children and to be frank, I haven't had one client go who who hasn't gone for purely for reasons that they were going to anyway, that has been driven by the current government or even the previous one. Um, I think it's also important to remember as well that we get potentially kneecapped by the 5-year rule. So if you do go, if you do t change your residency purely for an income basis, then that's of course fine. But from a perspective of things like rebasing for capital gains tax purposes, I mean that's you go on for 5 years, and that's a big commitment. So that's a difficult one. You know, the one thing I have seen which just sort of made me laugh more than anything else was there's another form of sort of investing which is offshore investing, offshore bonds. We do a lot of these. It's not. It sounds sort of very racy in Panama Papers. It's not. Ours is based in Dublin, but it's just another way of holding a portfolio. They are taxed as income, so they do actually sit around the tax year, rather than having a specific rule like the CGT 5-year rule. So in that position, we have seen people who might have gone, right, we'll go to Dubai a few months before April and then live there for a year, pull everything down at zero income tax, and then wait for a few months after the following April and move back. So something where it's not so cut and dry about where HMRC would say, well, like, we know exactly why you went there. But just utilizing a temporary movement as a way to minimize one tax moment, which is doable. But I think broadly speaking, I don't know. I could repeat what we've all read in the press, but I haven't seen it really personally.
No, that's interesting, Nick. And you raise a good point. There is lots of other options. It's just the one that gets the headlines. Manisha, any other builds on that at all?
Well, I think Nick's covered most of it, but I'd like to talk about the people actually coming back to the UK. You've got a lot of Spanish expats, Singapore expats, even the person that runs Wikipedia has become a British citizen. So there's a lot of confidence in Britain. The reason why they're coming back is that whatever money they bring over is tax-free. So they pay 45 pence. So there's no need to switch the lights off in Britain at the moment, but it's not that dire. But there are other people coming in the other direction. And I think the media has got, it gets clickbait from running the country down. So do sort of take a step back. And this is a beautiful country, but you just need to make sure that you're in control of your tax affairs. You're in control of your business, not Rachel Reeves or Tried or whoever. So it's just about taking control and taking a little bit more depth. That's my point.
I like it, nice and positive. And Jess, any final builds at all?
Yeah, I suppose we're often looking at it from an inheritance tax perspective. So people are wanting, or people are considering leaving the UK to get outside of the scope of inheritance tax. And we've moved now from a domicile-based regime to a more of a strict statutory residence-based regime. So that's quite a big change for the UK. Could make planning maybe clearer. Domicile was quite an opaque concept, and people argued lots of different things, and HMRC argued back lots of different things on domicile. Whereas now it's about, are you long-term resident here or not? Depending on how long you have been long-term resident here, leaving, there's a tail when you do leave. So it's not like an immediate, you're outside of the scope of UK inheritance tax. So yeah, lots of planning there. I think lots of talk about Dubai. We see that from maybe a slightly younger generation, that it's good to go out there to work, to grow your business. But is that where you want to retire to, and sort of set up your retirement life, you've not got maybe the support network that you have at home, all those sorts of things. Is that really worth it for the inheritance tax differences? I don't know. We will see. But yeah, it's a one people talk about a lot, but no, I haven't seen huge amounts of people go to Dubai for the long term, I'd say.
Yeah, no, that's good. Okay, so final question then for all of you. What one action should our business owners take away, or I'll take tomorrow to kind of help them navigate the changes in this budget? And I'll start with you, Nick.
With me, I think it's like I mentioned about allowances. It's all one way. I think use any allowances you can before they go. And for me, that's the big one is always pensions for business owners. To have that money coming out of the business, it's deduction for the business. It's in your hands. It's a deduction for you. I mean, it's a real no-brainer.
Okay, that's great. Manish?
Um, get some software like Xero or QuickBooks and keep your pulse on the cash flow as if you're buying something at Sainsbury's or Aldi. You're checking the prices, or you're checking the expenses and income for your business. So micromanage your business.
Yeah, lots of nuances there to navigate. And Jess?
I'd say probably going back to the will point of make sure they've got a suitable will in place. Are they leaving everything to a spouse just for the inheritance tax benefits? Are there any other reliefs you can be capturing as part of your will planning? Because rules are changing next year, but who knows how they may change again in the future. So yeah, a good will in place to try and capture reliefs whilst we have them. I'd say is essential for SME owners.
Yeah, brilliant. Okay, well, that concludes then all of our questions for today. So thank you very much, Jess, Nick, and Manish. Some great insights there. I certainly feel like I've benefited from all of your expertise. We have a few more minutes left for questions if anyone's got them, although we could probably run over a little bit if Nick, Jess, and Manish are okay. Is there anything from anyone on the call you wanted to ask?
Do you think in a way the changes are more minor than the media's presented, or do you think they are quite significant and will have a significant impact on businesses?
Nick, do you want to take that one, Manish?
Yeah.
Manish, you go.
Yeah. So I think there's a sort of a dual message. The budget's looking in two directions. One you've got is signposting you towards a tax structure that works for your business. And another thing is looking towards 2030. So the original idea is so you build up your business, and then at year 3, year 4, you can actually sell it to an investor. And if you look at the AI industry at the moment, they're all being sort of, not groomed, but harvested for the American tech people. People know that British businesses are resilient. We're quite honest in terms of our accounting. So even the books, they look okay. They can trust the books. And the UK is in such a beautiful spot. It's got free trade with India. It's got very close to Europe. So I've got one friend, she's actually launched a beauty product in India from the UK. She's benefiting from the free trade there. And the actual goodwill that Britain's got around the world is something that we need to take advantage of. So she said, well, why do I put a British flag on my product? It stands for trust, reliability, and honesty. So the budget is trying to make sure that you grow your business in such a way that you take out less tax and put more in towards your sales budget, your marketing budget, grow your business. And then in the other way, it's trying to sort of create a flat structure. So if you're an established high street, say somebody like Sainsbury's, what they want to do is want to make sure that the small shops can actually compete with their buying power as well on the retail side. So they want to make it sort of flat for everyone to sort of enter the market, because you don't need to be sort of a scientist to work out that what Sainsbury's is selling that baked beans for, the local shop can't get that same price. And that's same for other small businesses as well. So what they want to do is they want to make sure that the big companies don't grow too big and the small people are not left too small. So they wanted to sort of level the playing field. So even small business is quite good towards your high street, your partnerships, people that got investors. Because at the moment you're doing everything yourself. But what the journey is, that you can actually get your business ready to sell to an investor. And that's the whole, they want to create an eco structure. It's not the Labour government, but it's a sort of legacy from the last government as well. But they're not so clear on the messaging, and they're not so clear on how you get there. And when you look at business advisors locally, they more sort of concentrate on the smaller picture. They're not concentrating on the bigger picture. But that's just my interpretation, because I speak to quite a lot of people, and I look at the industries, but I always take a step back, and I always think, where will this business be in 2030? And it's a question of mindset, and always think, I want to sell it to an investor. Your business decisions will become clearer, and you'll actually start getting a return on even a spare minute that you could put in the business. So it's all about a different mindset on that one. It's not an American mindset. It's more of a British mindset. That's my interpretation.
Yeah.
Thank you.
Does that answer your question?
That does assist, yes.
Yeah. Any further questions at all? No. Okay. Well, we will be sending the recording out off the back of this call. So we'll share that with you later today. But yeah, thank you very much for joining, and I hope you found the session useful. And yeah, look forward to keeping in touch. So thanks, everybody.
Brilliant. Thank you, Joe.
Thank you. Take care.
Thank you.
Bye.
It's very helpful. Thank you.